Hello everyone, you're welcome to our channel Promotion for Sure. In this video, we are going to talk about Chapter 14 Liquidity Risk Management, Module B Risk Management of CAIIB course. Now, in this chapter, you will read and understand liquidity risk, classification of liquidity risk, management of liquidity risk, measurement approaches to operational risk, and liquidity risk management policies, strategies, and practices. Now, liquidity is having enough cash to meet the current needs, and liquidity risk is the current and prospective risk to a bank's earning, and equity arising out its inability to meet the obligation when they become due. Thus, effective liquidity risk management is the management of liquidity by raising sufficient funds, either by increasing liabilities or by converting assets promptly at a reasonable cost. Now, what is the need and importance of liquidity risk management? Now, the liquidity problem in a bank could be the first symptom of financial trouble, which shall need to be assessed and addressed at an enterprise level. Now, we can very well imagine what will happen to a bank if the depositor wanting to withdraw his deposit is told to do so later or the next day in the view of non-availability of cash. It will be a havoc situation because not only one customer but all the bank customers will come and demand cash from the bank. So this is very dangerous. So some of the consideration in liquidity risk management includes availability of liquid assets, extent of volatility in the deposits, degree of reliance on volatile source of funding, level of diversification of funding sources, historical trend of stability of deposits, quality of maturing assets, market reputation, availability of undrawn standbys, impact of off-balance sheet exposure on the balance sheet, etc. So some of the issues that needs to be kept in mind while managing liquidity includes the extent of operational liquidity, reserve liquidity, and contingency liquidity that is required. The impact of changes in the market or economic conditions on the liquidity needs. The availability, accessibility, and cost of liquidity. The existence of early warning system to facilitate prompt action prior to surfacing of the problem. So what are the potential liquidity risk drivers? There are internal banking factors and external banking factors. So if we talk about the type of liquidity risk, the bank faces normally two types of liquidity risk, which is funding liquidity risk and market liquidity risk. So what is funding liquidity risk? It is a risk that a bank will not be able to meet efficiently the expected and unexpected current and future cash flows and collateral needs without affecting either its daily operations or its financial condition. What is market liquidity risk? It is a risk that a bank cannot easily offset or eliminate a position at a prevailing market price because of its inadequate market depth or market discipline. So there are several principles for sound liquidity risk management which was given by Basel Committee on Banking Supervision. It had published principles of sound liquidity risk management and supervision. So there are in together 13 principles, and it emphasizes on the importance of sound liquidity risk management system. So the governance of liquidity risk management is in the form of board of directors at the top, the risk management committee after that, the asset liability management committee, which is ALCO, and the asset liability management support group. So liquidity risk management policies, strategies, and practices. The first step towards liquidity management is to put in place an effective liquidity risk management policy, which should spell out the liquidity risk tolerance, funding strategies, prudential limits, system for measuring, assessing, and reporting, reviewing liquidity, framework for stress testing, liquidity planning under alternative scenarios. So that these are some of the ways. Liquidity risk tolerance. Bank should have an explicit liquidity risk tolerance set by the board of directors. It should define the level of liquidity risk the bank is willing to assume and should reflect the bank's financial condition and funding capacity. So, strategy for managing liquidity risk should be appropriate for the nature, scale, and complexity of bank activities. Management of liquidity risk can be done through identification, measurement of liquidity risk. Now, some of the important ratios in respect of liquidity risk management is volatile liabilities minus temporary asset, core deposit divided by total assets, uh, loans plus mandatory SLR plus CRR plus fixed deposits divided by total assets, temporary assets divided by volatile liability, core deposits, earning assets, temporary assets, volatile liabilities. Now, these are some of the important ratios which the banks and the financial institutions use to measure the liquidity aspect of their portfolio. Now, what is stress testing? Now, stress testing should form an integral part of the overall governance and liquidity risk management culture in banks. A bank should conduct stress tests on a regular basis for a variety of short-term and bank-specific market-wise stress scenarios. Now, it includes risk associated with business activities, products, and funding sources. The defined scenario should allow the bank to evaluate the potential adverse impact these factors can have on its liquidity position. So, the stress test results and the action taken should be documented by banks and made available to the Reserve Bank or the inspecting officers. What is contingency funding plan? Contingency plan should contain details of available or potential contingency funding sources and the amount or estimated amount which can be drawn from these sources. Clear escalation prioritization procedures detailing when and how each of these actions can and should be activated so that the lead time can be reduced. So, this is something which we all should be aware of. The liquidity aspect, which is very, very important. Let me ask you certain questions, which I'm sure you'll be able to answer in the description box below. Question number one: the overall responsibility of management of liquidity risk lies with. Question number two: the role of deciding the transfer pricing policy of the bank and making liquidity cost and benefits an integral part of bank strategic planning is performed by. So I hope you would have liked this video and learned a lot about liquidity risk management from this video. So if you like this video, you can press the like button, subscribe to our channel and share it on social media. Help us to spread education in this beautiful world. Thank you. Have a great day.